My name is Rick Brimacombe, and on behalf of the Minneapolis Club and my firm, Brimacombe and Associates, welcome to Club Entrepreneur. I've been doing venture capital deals for over 20 years, and I help companies refine strategies, assemble resources, and secure funding. Regarding Club Entrepreneur, I started it back in 2007 after 2 stints in the venture capital world. I was a junior guy at Norwest Venture Capital, a big national fund, and then I co-founded Sherpa Partners with 2 other guys, and then started my own company that I've been working on since 2005. One of the things I learned as a venture capitalist was that the only things that you as an investor can control is the going in price and the going in terms, and as such, investors therefore are hypersensitive to the price they paid. And from the entrepreneur side, many times, not all the time, but many times entrepreneurs had an overinflated sense of value and an overinflated sense of worth as far as the company goes. So that's my lens on the valuation conversation, which is the investors are always trying to push the price down and the entrepreneurs are always trying to push the price up. Although one of the things that often happens, an entrepreneur pushes the price up too high, they paint themselves into a corner and have trouble raising money downstream. But that's a different part of our conversation today when we dive into the discussion on valuations. But before we get to today's panel, I want to thank our sponsors. Schwegman Lumberg Woosner is an intellectual property law firm. Olson Thielen CPAs is a full-service accounting firm, and the folks here at Olson Thielen are well represented to my left. Irish Titan is a web development and e-commerce company. Sunbelt Business Brokers is a merger and acquisition advisory firm. McLeod & Company is a holistic marketing agency, and I know I have 3 folks here from McLeod, Tanya right up in here, and a couple at the back table. So thank you for sponsoring. Highland Bank, I have some Highland Bank folks here as well, right up here in front as well. So thank you to Highland Bank for being a sponsor. And then the Network Connect is a catalytic gateway for connecting people, money, companies, service providers, and I do that business with Dick Summerstedt. Network Connect is kind of a cousin to Club Entrepreneur, and they're also a sponsor. So thank you to our partners and sponsors. Without them, these things would not happen, so please, to the extent you can, frequent those businesses, and I've worked with all of them personally, so can speak to the experience being a positive one if you were to engage with them. Please remember to RSVP online. Generally speaking, we're the first Thursday of the month, and by RSVPing online, you help the club plan. In April, we actually moved back a week because of spring break with my youngest daughter. So in April, we'll be back a week, but generally speaking, it's the first Thursday. Ways to connect with the group, the website clube.com. There's a LinkedIn group, Club Entrepreneur-Minneapolis. That little card with blue at the bottom of it on your table can steer you towards that. There's also a meetup group with about 1,800 people, and there's an email list. If you sign up on clube.com or give me your card, we can get you to the email list. Minneapolis Club is a sponsor here with me, and have been working with them closely to make these events happen since 2007. If anybody would like to learn more about the Minneapolis Club or membership here, please seek me out. Business of the Month is something that we started a couple of months ago. That was a great idea from McLeod & Company. And so there's a fishbowl at the table out there when you're leaving. If you'd like to add your card to the fishbowl, we draw someone out of that, and then we have the Business of the Month. And this month, Doug Goley, where's Doug? Doug over here to my left, Doug Goley of PDS, which stands for Precision Data Systems, is this month's Business of the Month. And what those folks get is pushed out through the Club Entrepreneur social channels, promotion of their business. And we started that in 2018. So Doug's company is the 3rd one. And they have a product called the Owl Wireless Electricity Monitor, and what that does is it allows you to monitor electricity usage in real time in your own home. So for instance, if you're ready to go out for the night or whatever, and you can look at your little gizmo and you can see that, hey, you're clicking a little higher than you should, and guess what? Little Johnny and Sally left 18 lights on upstairs, like it happens at my house, which usually I don't see till I pull out, and the whole upper part of the house is well lit, but now with the little device, you can keep track of what's going on with your house. That is the Owl wireless electricity monitor, and again, Doug Goley over there to my left if you'd like to learn more about that product. And again, put your business card in the fishbowl if you'd like to be included for the drawing for April. All right, then the next announcement, the 8th annual Minnesota Entrepreneur Kickoff is this sheet right here. March 7th is that event. It starts, I believe, at 2 in the afternoon. Paul, is 2 o'clock the start time? Okay, 2 to 7, so you got 5 hours, multiple tracks, multiple speakers. I've been working with Paul Taylor on that to make that event a success. And Paul Taylor, raise your hand one more time, Paul. Paul Taylor can tell you more about that event, but it's a great opportunity to learn a lot of different things. As I mentioned, many different speakers, many different tracks, several hours to either pop in and out if you can't be there the whole time. So that's March 7th. Future Club Entrepreneur events, March 13th in Hudson. We are doing a talk on a sexual harassment claims, question mark. Now what, question mark. So given all that's happening in the world right now, if you want to learn about what you need to do as a business person with regard to sexual harassment, that's March 13th in Hudson. March 21st in St. Paul, Path of a Startup. We have a startup panel with a couple of different business owners. Chum Struve is right here up in front. Chum runs St. Paul. March 22nd back here, I'm doing a panel with Upsize Magazine on mergers and acquisitions. And then we get into April 10th in Hudson, April 12th back here for the regular clubby. Again, that's back 1 week. Larry Abdo is our speaker here in April for Club Entrepreneur. Who knows Larry or knows of Larry? Only a couple. Anyway, a couple over there too. Larry owns the Nicollet Island Inn. He owns My Burger. He started like 27 or 28 different businesses. He's a super entrepreneur, fun guy. And as I was mentioning to someone beforehand, A, it'll be entertaining, and B, it'll be unpredictable. So I would encourage you to come because I think you'll check both boxes, entertaining and unpredictable. So Larry Abdo will be here on April 12th. And that leads us, last but not least, to our speakers and our panel. The idea behind this panel was kind of to know why you should do your valuation and then how you should do your valuation. And so our panelists, all from Olson Thielen. Olson Thielen is a top 20, top 15-ish kind of accounting firm in terms of number of people. They have about 90 folks at their company. Roots of the business go back to 1921. I've been working with them through Club Entrepreneur and other activities since 2009. Proud to call them friends and partners in a number of different activities I do. So there are panelists today. To my immediate left is Mike Bromelkamp, a principal. Scott Hoyles in the middle is also principal. And then Tony Oman is a senior analyst and the newer guy to the team. But Tony is the valuation guru at the table. Not that Scott and Mike don't have opportunities to contribute because they do. They both are involved with the valuation business, but that's really in the crosshairs of what Tony does. And so with that, why don't we take a minute or so and you all give me a little bit more background. I've introduced you, but fill in between the lines a little bit in some color. Mike, why don't we start with you?
Because they said they wanted Tony to go first because I might say something that's inappropriate. But
we know.
Let me set a ground rule here before we get started. Because we're here to answer questions and impart information to you. Valuation is a really important subject, but we can also have some fun at this. We're going to tell some stories today that may curdle your milk. So if you get an uneasy stomach, just leave. March 17th just walked in, so we're probably have to talk about that as well. But
why doesn't everybody have the green
on? You know, if I'd have known you were coming, maybe we would have been there. I can wear whatever I want because I don't care anymore. My name is Mike Bromelkamp. For those of you that don't know me, I'm a CPA with Olson Thielen. Been with them for 25 years. I've been a CPA here in Minnesota for 40 years. And without telling you anything else about me, all I want to do is make a difference for my clients and my friends and entrepreneurs in the state. I'm very involved at a political level down at the Capitol. I'm working with a number of nonprofits to make a difference in my community that way. And I am blessed and grateful to have a number of clients that I work with at Olson Thielen. And one of the areas that I get involved with is business valuation. Now, these days I tend to do more expert testimony on the subject. And the senior analyst down here on the end, he's the one that actually does all the heavy lifting and does all the work, so I have to recognize him for that. Scott, what do you do?
Mike's obviously
How's that for a lead-in?
He's obviously the color commentator in our group. So I'm Scott Hoyles. I'm a principal, and I work out of our Roseville office. My specific discipline is tax. So when you talk about unpredictability, we're pretty predictable, really. And this time of year, we're pretty bored, nothing to do. So I'm kidding, really. And just so you guys know, how many CPAs here? CPAs? All right. Just so you guys know, tax reform is not fake news. It's real. It's for real. We're dealing with this right now, and that'll be part of my subject up here is how do you deal with tax reform, with valuation, how will that affect valuations coming up too. I've been with Olson Thielen for 9 years. I was there when I first got out of college and then did a couple other stints, been in the private sector also as a controller. So I have a lot of different business background, but tax is my main area.
Hello, everyone. I'm Tony Oman. As these guys said, I'm kind of the new guy. I started with Olson Thielen in October. Yeah, October. So relatively new with Olson Thielen. I started off in the private sector. I worked for, kind of grew up, I worked for 8 years with IBM, and then I worked for a local company here, Anderson Windows. I'm sure a lot of people are familiar with Anderson Windows, doing a lot of various financial roles. Got to do a lot of traveling back when I was with IBM. I went to grad school. I got my MBA from Carlson School of Management here, and as I was going through and doing that, I realized that valuation was something that I became very passionate about. So, as Mike alluded to, I'm kind of the valuation nerd. It's exclusively what I do at Olson Thielen, so I don't get involved in the tax or the audit side really. So I'm doing litigation support, valuations for various reasons that we'll get into, but that's kind of my main focus, and I'm excited to be here. Thank you.
And then again, the intention of this event is we have some questions. We'll go through those, but at any point in time, if somebody would like to chime in and ask their own question or add to the conversation, please raise your hand, and I will weave you into the conversation to the extent I can. Okay, so big picture, everybody, and this is an open question to the panel. Whoever wants to tackle it first, feel free. But big picture, why do valuations really matter?
Let me go first. Then I don't have to talk again. Primary reason we're trying to get the message across that each of you in your own way, you're either owning a company, you're investing in a company, you're trying to sell a company, you're trying to figure out how you're going to get into a company, you're trying to find out how to buy a company, and the biggest question always ends up being, what is the value? And I will point out that for each of us, for any given business, there are entrepreneurs that have, as Rick mentioned, have dozens of business. Abdo's done tons of them. But you only get really one chance to sell or buy a business in a specific case. And what we're trying to do is give you some rationale and some relationship to determine what kind of value you should be using to do a business transaction. You know, Tanya, you and I were talking beforehand. There's 3 big outcomes that happen when you buy a business. You can buy it for just the right price. Win-win situation. But you can also sell it for a lot less than what you should have gotten for it, or you can get a lot more for it than you should have. In the second 2 cases, there are a lot of bad things that happen. If you leave money on the table, your estate has just gone poof. But if you get too much, you are exposing yourself probably to legal liability on the part of the buyer because you got too much for it. What you want is that win-win transaction that says transaction occurred for value. Now, I try and convince my buyers that I work with all the time that they shouldn't necessarily be trying to get it for the cheapest that they possibly can. That doesn't always work, and understandably, and the same thing for people that are trying to do it for too much. But the bottom line today is that you get one chance to do a transaction and you want to do it right, and knowledge is power. And if you want to go in and do it on the basis of a multiple that you read in the Wall Street Journal or Forbes or some other financial deal, you have a pretty good chance of cheating yourself. And we're not the only guys in town that do valuations. We're speaking for the community in general. And knowledge is power, and you need to demand for yourself that you have that knowledge in doing a transaction.
Valuation also gives you opportunity to figure out what your drivers are, right? So if I know what my value is right now, part of what we try to do when we value a company is, hey, we're going to show you what those drivers are, where you're lacking, and where you can pick up some value down the road. So if I know that, it gives me some direction on where I can go with my company. So that to me is a very important part. You could be wasting 10 years of your life not building that value in your company, where if you knew back here, this is how I valued it, this is pieces that I needed to shore up where I was discounted heavily on before, now I'm not, that's going to help you out in the long run.
Yeah, I think I would just add, you know, I think from a general perspective, I think if people in business and making decisions better understood, to Scott's point, you know, what actually creates value, not just what the number is. I mean, we're all interested in what, you know, what my business is worth or what the business is worth that I'm buying. I think, you know, markets, private markets, public markets, we have a lot more stable environment. I think when we get into trouble is when we misunderstand what actually creates value. So I think from my perspective, I mean, it's kind of a maybe big picture philosophical view. I think, you know, for people to understand what those drivers are and what creates value is extremely important.
Great, thank you. Mike, you kind of alluded to the fact that sometimes things can go bad. So tell me or tell the audience here a little bit about some more stories of where things didn't work out as well as they could have.
I'm going to take one more look around the room here because I want to make sure that I don't tell any stories. I see M&A people here, and I gotta keep it clean. My favorite story right now is that about 5 years ago, I had a company from Southeast St. Paul. They were in a had a processing company. They basically took 55-gallon drums and rehabbed them. And that doesn't sound like much of a company until I tell you that they were doing probably $25 million worth of this work on an annual basis. And the company will remain nameless, but 5 years ago they received an offer from a large German organization that offered $7 million for their company. And this was before we had started to work with them. And they basically came back to us and said, well, how can you help us get this deal done? We like the deal. It would basically be making the two owners independent enough that they wouldn't have to work anymore, at least in their minds. And to keep it short, the German company basically started at the $7 million and then decided that every time they found a value driver that didn't meet their guidelines, you know, your accounting records aren't good enough. You know, so that leads us to not trust you. And so we need to discount our price a little bit. They found some uncertainties in the customer agreements that they, you know, weren't as solid, may have some legal difficulties with it. So they got down to where the price was getting into the $5.5 million range, and we were working with them, and he just said, you know, if you're not comfortable with the price, keep on operating. They're making, you know, $1 million a year. And after a lot of soul searching, they decided to walk away from it, and thank God. 2 years later, another American company that was a strategic buyer in their same marketplace who knew these guys real well. Trust was high. They had made even more money in the ensuing 2 years because they had learned value drivers from some of our analysis. They picked up an offer for $35 million, which included the real estate, but it was a long cry ahead of the $7 million that they had been offered. It turned out to be a good story. I wanted to start with that one because it ended up with a good end. Now imagine yourself as the owner of the business that sold it for $7. You're never going to know that that $35 million offer was going to come by. But in the end, you would have ended $7 million offer went down to 5.5. You split it with your partner, so you're worth $2.75, $2.25 million. It just would not have been a good outcome. You can leave a lot of money on the table, and you'll never know you made a mistake. The guideline that I would say when you're trying to tell a good story is that you want to be confident that you're getting value. If you're a buyer, you want that you're giving value. If you want to hear some really bad stories, as an Arthur Anderson guy, I can talk about the Enron deal. There are value drivers that are beyond cash flow, beyond market value, behind even asset value. You get yourself into some legal problems, your value is going to go absolutely in the tank. You don't have numbers. You don't have financial numbers. You don't have to have your audited financial statements if you're a $2 million business, but if you get larger than that, maybe you need audits. But the fact is that you got to put yourself in the position of the buyer if you're selling. What are you going to be giving them? What are you worth? Your business is only worth what you're able to sell it to for somebody that can perform. I'm going to leave it at that. Rick also has some of these stories that he can tell, but I think he's being shy.
Oh, wow. Trying to give you the opportunity. Okay, so somebody who's thinking about selling, we just talked through, all right, yeah, maybe you don't get enough, maybe it's not the right time, et cetera. But what about somebody who's not really thinking they're ready to sell quite yet? Why do they need to go through the process of valuing their business?
I think I'll start with that one. There's a lot of reasons that you need to have a valuation, right? So if you're going to gift something to your kids, you have a business and you want to gift some shares to your kids, that is a reason that you're going to need a valuation done. IRS requires a full valuation. So you can go do something on a napkin maybe, or find some multiples and put it down, and then that's the number you're going to give to your kid, but that's not going to hold up with the IRS. It's not going to hold up in court. So gifting is a big one. This year the gift exemption amount is $15,000. Obviously, with the new estate tax rules, you're up to $11 million in exemptions now, which is huge. But over the next 10 years, remember that sunsets. That's not forever. So you have to pay attention to that, and there's good opportunity to do estate planning. We're not here for tax, right? I love tax, so I might get off into that. Estate planning is another one. A shareholder passes away, you're going to want to have a valuation done for that. Even if it means you're not going to have to file an estate tax return, right? Because 2017 it was at 5.9, somewhere in there. 2018 now it's up to 11.1. So I may not have to file an estate tax return, but I can get a stepped up basis in those shares, which means I'm not going to pay as much tax down the road. So it definitely is worth your time to be doing a valuation for those purposes. ESOPs, employee stock ownership plans, those have to have valuations every year. Good opportunity for business owners to sell off part of their business, right, to an ESOP. Engage the employees in your business a little more. It's a little expensive. Some of them have to have audits. Some of them, obviously, you have to have a valuation done every year. It's pretty well regulated, those ESOPs are, so that's another reason for it. Buy-sell agreements. If your business does not have a buy-sell agreement, or if you're an owner or shareholder, you definitely need to have a buy-sell agreement. And most of those buy-sell agreements are going to be funded by life insurance. Well, how are you going to know what value to put on that life insurance? Well, you should have a valuation done. And you can't just do it once, right? Because I may set up my business and have it running in 2 years and do my valuation now, and now 10 years down the road, my value just went up 10 times, but my funding of that life insurance is way behind. So somebody's going to be messed up. Somebody's going to be working with the spouse's, the spouse of the other owner, which may not be a great deal. So,
If you want to
just
hear
a
horror
few-
stories,
yeah, we've got some.
we got more.
Yeah. So, sorry, I'm talking off. You guys want to chime in? Oh, let me.
Go ahead.
Here we go. Sorry. S corp conversions. So, if you're a C corp right now, obviously tax reform changed a lot of this. So C corps are now taxed at 21% flat rate, right? So, which is a great thing for C corps. Are you going to have S corps going back to C corps? Probably not. We're going to think about that, right? So, are you going to have C corps going to S corps? Maybe. But that is a reason to have a valuation, because if a C corp goes to an S corp, there's a thing called big tax, built-in gains tax. And if you sell things within the next 5 years of becoming an S corp, you may have to pay tax inside the S corp. So, sorry, I don't want to get technical, but that's a reason to, if you do a conversion, you're going to need a valuation done there too. So, okay, I'll stop talking.
The one, I guess I can think of a couple other reasons. If you're thinking about issuing stock compensation, you'll need a valuation for those purposes as well. And then I guess it's sort of related to transactions, but if you are following GAAP and there is an acquisition of assets or an entire business, there will be fair value reporting requirements. So we can kind of lump that under compliance, but that would be another reason that often someone like myself would come in and value, in this case, specific assets.
Now, those are the hard requirements under compliance. Let's talk about litigation for a second. Without asking the question, I'm going to ask it anyway. How many people in here have been involved in a divorce in their lifetime? Okay, Eric, we're friends, so I'm going to call you out on this. How'd that go? And that's just, I just wanted to put the spotlight on the type of transaction, because I do a lot of divorce work, and what happens in a divorce is that it gets very emotional. I hope that you had a somewhat friendly separation, but they don't always happen that way. In many cases, we get put in the middle and say, how much is the interest in this business worth? When the emotions get thrown in there on top of the compliance requirement, it gets very, very interesting. We get brought in all the time, and in most cases, these cases do not settle. These cases provide me the opportunity to go and say hi to the judge after saying I do. Shareholder disputes the same way. Marriages are really great when things are going well, but when they go sour, they go bad. In many cases, the only way you're going to be able to decide how to cut the pie is through a valuation. Damage calculations. I'm involved in litigation project right now where the minority shareholder basically got shoved out because the business was too profitable and the majority owner wanted to keep it all for himself. Under Minnesota minority shareholder rules, things are kind of interesting, but we had to value the damn thing so that we could figure out where to go with it. Bankruptcy. Bankruptcy referees can get really excited about the fact that you claim that your business isn't worth anything, and it probably is. And then the creditors get involved, as well as the shareholders and family members of the estate and things like that. These are types of situations where valuation, the information, knowledge is power comes into play. Hopefully it doesn't take you all the way into court, but many times it does. The third area that we get involved with is advisory. Ron probably knows a little bit about this because you're involved in enough transactional work. Somebody comes to us and says, well, I'm thinking about selling. I'm 64 years old and I want to sell by the end of the year. Well, Ron and I throw them out on their ear because they really need to be thinking about this 5 years ahead of time. You want to position your company to get the most that you can get, but you need to know what that number might be so that you can plan for it. We've already talked about buy-sell agreements, but just strategic planning. You're involved in a startup, and you're thinking that your exit might like to be in 5 years. You're going to have to do some projections. You're going to have to do some ideas. You have to find out what those value drivers in your business are, and a business valuation can help provide that. To summarize, compliance, litigation, advisory services, and believe me, we've seen, can they say damn near? Damn near everything. Nothing surprises us anymore, and the opportunity to work with all kinds of different businesses provides us with a perspective. You might only see it once in your life. We've seen it hundreds of times, if not thousands of times.
All right, thank you. Tax law changes. We hear in the news about kind of the personal income stuff, but how, if at all, has the tax law changes impacted the valuation world?
This is something that's going to take some time, I believe. If you look at it, C corporations went to 21%. S corporations, obviously, the money passes through. IRS says you can't tax affect S corporations, so basically you can't give them any value because they're an S corporation. We don't always follow that, do we?
No.
So, any IRS agents in here? Shoot, I should have asked that first. So I think we got to play it out, because the 21% for C corps, that's obviously going to add value, right? Because you have more cash after tax to be able to invest back into the company or to provide to the stakeholders, the shareholders. So that's there, but there's also this limitation on interest deduction that came out for businesses that are 25 million and above. So that could affect it the negative way. So they're kind of playing off of each other. I think the difficulty is, and Tony's talked about this before, how are we going to build our models in order to make this work? Our income approach, how is that going to look? Market values are going to probably change a little bit on when we're looking at multiples and of sales and multiples of EBITDA. So to answer the question, I'm not sure. No, it's going to be, we're going to play it out. We're going to have to look at it. It's going to take a little longer to do analysis on it, but.
Yeah, I think I would just add to that, from the tax law perspective, I think a lot of people think, well, I'm going to have more cash flow, so my value goes up. And all things held equal, that's true. But as Scott was mentioning, when we think about, and maybe we'll talk about a little bit later, but when we think about how much capital costs and the value that's placed on debt, so capital structures for companies specifically that carry more debt, we could see that change. And over time, as the market adjusts to these new rules, those inputs are going to change. So, I think the net effect will probably be an increase, but as Scott said, I think there is some offset to the idea that, well, I take home more cash, so value automatically goes up. It'll end up somewhere in the middle.
I'm smiling because I'm looking at all my banker friends in the room and know that they absolutely understand how this Tax Reform Act is going to affect everything. It's going to make it a lot easier for clients to satisfy their covenants, because they're going to have all this money in cash flow and all this other stuff. And the fact is that it's only going to make it more complicated. And if you have bank debt, you probably should be talking to your banker now, because you need to get in line first. You don't want to be the last one in line to help the bankers understand what the value of your business is.
All right. Tony, kind of into the nuts and bolts of business valuation. Give us a little background on kind of the different ways to go about valuing a business.
Yeah, I was talking with a few folks before we started. There's a lot of different ways that I guess I see businesses being valued. Mike kind of touched on multiples, and sometimes people talk about monthly sales multiples or an EBITDA multiple or these kinds of things. And I think sometimes those are right, sometimes they're fine. But to Mike's point, it can get you in a lot of trouble. I can bring up horror stories. One of my clients currently, they bought a business about 5 years ago, and the way they valued it was they paid for the assets, and then they came up with a number of what goodwill should be. And the best I can come up with is the sellers wanted to divide goodwill divided by 2, and this is what they need to retire. So that's what they sold the business for. Our clients, the buyers, now 5 years later, are in a situation where they funded that transaction with some notes, some debt, and they're in trouble. I mean, they can't pay for it, and so the company was grossly overvalued. My advice would be to not do that. Really, when you bring in someone to do valuation, there's really 3 different approaches that they're going to do. 2 are most common, and really there's, we call it an income approach, which is, these are what I'll call the intrinsic value of the business. What are the cash flows that the business generates? And I think, to kind of build on Mike's point, when you're in a transaction and buyers or sellers, I think there can be that's where a lot of the negotiation comes in, or understanding what the assumptions are about those future cash flows. And if both sides of the transaction, can kind of push back and understand the assumptions there, that will help the process. But so there's an income approach, and then we do look at market multiples. So we'll look at the public companies that are comparable. We'll look at transactions, and we'll look at sales multiples. We'll look at EBITDA multiples, and depending on the nature of the business, that can depend. But I would argue that's really kind of we use it to triangulate the value from an income approach. So, people making decisions strictly based on multiples, I think, again, sometimes those are fine. Sometimes that can get you in a lot of trouble. In my mind, a multiple is really just the output of the cash flows the business generates. So you may be higher, you may be lower, but these are the things that when you're thinking about a valuation, or when someone's going through and doing a valuation, those multiples are really used to triangulate value. The third approach is, we call it an asset approach, and basically what happens in these situations, Mike brought up an example of bankruptcy. If there's a distressed situation, sometimes a business is worth more dead than alive. So you go through, you do projections, you try to come up with cash flows, and you basically go through the balance sheet and value the assets and the liabilities, and what you're left with is more value than you'd have to continue to operate the business. So that can be kind of often a floor valuation for people in certain situations. But for the typical situation that we see, there is usually an income approach and a market approach, where multiples are used to help you assess the reasonableness of your projections and your cash flows.
Do you think Blue Buffalo, that being purchased by General Mills for 25 times EBITDA, is insane? We reached the top of the market of insanity? I don't know. Hold on a second. I don't know if you heard it over here, but a comment was about a acquisition for 25 times EBITDA, and does that mean we are now at a top in the market?
I think that's a great question. I think the problem with transactions, and we talk about this with clients, is you don't know what the buyers are paying for in terms of synergies. I've worked in the past with United Health Group on a lot of their transactions, and I can tell you the multiples they pay are insane. I mean, it's like that. They're getting a lot of synergies. I've seen very scalable businesses, software businesses, very scalable products where you can deploy a product through a sales model and you get a lot of revenue synergies. In those situations, that may actually make sense to that buyer. But I mean, to answer your question, multiples in the public markets are high right now. But when you start talking about transactions, it becomes difficult if you're making a decision strictly based on transaction multiples that my business should be worth 25 times EBITDA. Because it's impossible to understand what every buyer will look at. So, when we take the perspective of a market participant. So what is the average buyer going to look at? And those synergies that come into those types of things, that's often drives multiples to be what we see, these insanely high multiples. But without the background, I agree, it's tough to justify it. And the other thing I'll say, and then I'll stop, but when I've worked with public companies and in their transactions, often I see the decisions to make to price the deal come before the analysis. So things are agreed upon, quite frankly. The analysis is the catch-up. So I'll work with a corporate development group that's building a business case to the price they need to hit. and they'll build synergies, and you can make anything work in an Excel model. Okay, so I would just advise people to be careful, and I see at least a few people shaking their head, but in the public markets, I've seen that happen more frequently than I would have ever thought.
And of course, we deal in more of the private markets than the public markets. I know a little bit about the general Mills transaction here, and the 25 may not be the 25 times that you think it is. I'd take a look at their public documents and figure out what they really paid, and I don't think it's 25 either. It's more important for us to talk about the small and medium-sized businesses, that don't have the assets that General Mills has. I mean, they don't do dumb transactions most of the time. They project what that market's going to do. Blue Buffalo is actually a pretty good brand. My wife likes it because she buys it for our dog, and she wouldn't buy anything else. Well, product loyalty can go a long way, but unless you want to, march on Washington and claim that 25-time multiples need to be. What are they paying for Amazon? Have more fun. You need to have more fun.
I think a great example of what you guys are talking about is that rig guy today sold into Amazon for $1 billion. When you're talking other factors, right, that go into play. But the question that I had is you see so much of this unknown cyber threats when they're in these guys' networks, and they're going east and west, and you're evaluating a company. So what if you're the company that's evaluating Target 6 months before the Black Friday comes? So how do you guys, or do you even account for the fact that these guys may have their data breached, and they may have people in that system that they don't know? How would you guys know?
I'll start. You can
Sure.
pick up. I mean, to us, okay, so when we're doing evaluation, we're doing evaluation as of a date, right? So as of that date, if we know that they haven't been breached, I'm not worried about it at that point.
Well,
So,
they don't know, and they are.
well, yeah, and we can't, obviously you can't.
Then we sell them a sock audit.
Yeah. We can do a sock audit for them and find out if there's a breach. No, but yeah, I mean, you're valuing as of date. If we don't know, they don't know, we're going in blind just like they are going in blind, but we're trying to do our analysis on what we do know at that point.
It's a lot of gray stuff. I mean, when we're doing evaluation, as a counterpoint to that is we're looking at the quality of management. If we come to a conclusion that quality of management isn't very good, it's going to go down. We'll probably, if we don't put in a discount, we may at least adjust the numbers going forward. I always look at a company, for example, to see what kind of attention they pay to risk management. If all they're doing is talking to a broker and the broker's piling on insurance coverages, I'm expecting there's a problem there somewhere. In today's world, and I think I'm a little versed in IT. I've got a master's degree in IT, and I understand this stuff. Valuation going forward is certainly going to be a lot different than it has been in the past. Target, I don't worry about Target as much anymore because they've done the work. I mean, they've tried to bring that baby back, but it's the ones that don't have those problems. Or, maybe my friends in the Internet of Things area, we got a little problem with treating security there. You got to be able to handle that. I think I think technology has surpassed mankind's ability to absorb it and control it. But as professionals, we do have to take it into account. So it's a wonderful question.
Good question.
How you quantify it. 5 years from now, well, for those of you that don't know, I'm about 5 months away from the promised land, so maybe I don't care as much. But evaluators 10 years from now are going to have challenges. I don't even think an audit is going to be what an audit is today. I think it's going to be something quite different for that reason and others.
I would just say I agree. I think it's a great question. I think from my perspective, value changes. And I think some clients that can be something that's hard to understand. But I mean, look, valuation is forward looking and no one knows the future. So, you use the best information that you have at the time. But to your point, I mean, do we account for it? I mean, we try to identify through a diligence process, management interviews, if anyone's been through something like this, where those risks, you're trying to identify those types of issues. But 6 months down the road, if something like that happens and you say, Tony, what were you wrong? Maybe. I mean, at the time, based on the facts and circumstances we had at that time, the value was reasonable. But I mean, the truth is, if any of us have made an investment in any company, I mean, things do happen. And, I think the short answer is yes, we try to, but value can change over time. And if someone gets hacked, that's going to be an issue, yeah.
Okay, a couple things. Jim, can you hold your question? I had a couple that I want to get in before we wrap up. Also, I didn't say it earlier, we have the room as long as anybody wants to stay. So to the extent that you didn't get your question asked, feel free to come up to these guys or myself afterwards, and happy to help you. Shifting to some tactical questions, just kind of how these things work. I know there's a number of people in the audience who want to know things like, all right, well, who actually can value my business?
Anybody can value a business, right? I mean, you can do it on a napkin. You can take some multiples, as we've talked about. There's a lot of research out there where you can get those multiples from. But if you're going to, love these name tags. If you're going to do a valuation for business purposes, for IRS purposes, for court purposes, litigation, something like that, you should have a credentialed person do that. What is it? What's credentialed? I'm an ABV, Accredited in Business Valuation. Now that's the AICPA's credential. Tony's working on his ASA, which I would say is probably the elite. Would you say that's the elite, probably, credential?
I would agree.
Thought I'd give him that one. And there's other ones out there, right? There's other credentials. So I would just look at, if you're going to have a doc, you should have good support, is what I'm trying to say. If you're going into a business transaction, a litigation type thing, or an IRS, if you know something could be scrutinized by the IRS, get something done that's got some credentials behind it.
And it's not hard to find those practitioners in this town. We have a very robust valuation group here in the Twin Cities, and you can find them almost anywhere. So a good Google search and you're going to come up with a lot of them. But the credentials really matter. If, without my credential, I couldn't go to court as a witness because the judges, because they don't understand in the first place. But keep going.
Separate conversation, tying into the divorce thing.
I'm certified.
All right, so not that we're going to negotiate with you here as far as pricing goes, but what's like a range of evaluation cost, and then from a timing perspective, how long do these things take?
Cost, okay, I'm not going to, cost, that's a difficult thing. There's a lot that goes into valuations, right? Usually when we get into a valuation, we're going to give a quote, we try to get a balance sheet, because the balance sheet is going to tell us what usually is what's operating and what's non-operating. We have a lot of telephone companies that we do work on, telcos, these small rural telephone companies, and if it wasn't for their investments in these wireless companies, they probably wouldn't be around. So we have their operating company, but then we have their investments in these other investments, and you end up doing valuations on these other investments. So you're doing a valuation inside of a valuation. So we're always looking at the balance sheet to see what's operating, what's not operating, so you don't get stuck in that black hole of time where you bid at that 10,000 and all of a sudden you got 30,000 into it because you really didn't pay attention. So if I'm talking numbers, a calculation report could go. Calculation report, by the way, is something that looks at maybe one method. You're looking at two methods to try to be reasonable with each other, and that's agreed upon with the client. A full valuation or an opinion of value, that looks at all three methods that Tony talked about earlier. So a calculation report would be anywhere, you could be talking $4,500, $5,000, could go up from there. Full valuation is going to cost $9,500 up to $25,000, $30,000. Depends on what's all involved inside of that company.
Yeah, no, I think, I guess from a timing perspective, again, I would say it depends. If there's situations where we're holding up a transaction, those can be, you know, done a lot, quicker if need be. But I think if we get all the information and we have what we need, I think we typically plan 4 weeks, 5 weeks. But again, it can kind of depend on the pipeline and what the needs are. So it's usually you know, we try to keep it a fairly robust process because there's a lot that goes into it. There's diligence and that we're trying to do to understand the business. So that's what can take some additional time.
And it is it's fairly invasive. I mean, there's a lot of information we're trying to get from the company in order to figure out what all is going on here, what are the agreements involved. So just getting the information can take a lot of time just to begin
Our
with.
philosophy in doing valuations is that we are going to give you an opinion that would be opinion of an independent third party. And a lot of my litigation clients look at me and they're always trying to negotiate me to, like in a divorce. You know, if it's the spouse that didn't own the business, they want the business to be valued up here and they go down there. We're looking at it from an independent third party status. So we need a lot of information. We do need a little bit of time. We are able to work under emergency status, right, Tony?
That's right, yes.
That's the right
I have
answer,
weekends that get shot down pretty quick. So, yeah.
To give you everything that we'd like to tell you in 45 minutes is really difficult, and I hope that we've been able to give you some perspectives. It's a serious topic. It's hard to have fun with it, and I try, but and I know you guys try too. But I don't know that we're at time, right?
We are, but I'm gonna. Jim, was it a quick question, like a short kind of yes/no-y thing, or a big middle? All right. So why don't you come up and see them afterwards? Okay. So because we are at about time, to wrap it up in a positive way, because there were some horror stories and some things to maybe have some concerns, and I wrote down about 15 different reasons why somebody should do a valuation. And again, these guys are here as long as you all would like to talk to them. So a lot of reasons why to do the valuation and so forth. One of the things that Helen asked, I saved it for last, was to talk about the factors that you've seen that drive or increase value. So since we're kind of bumping up on the time, more kind of shorter answer, what's 2 or 3 kind of bullet pointy last little nuggets of wisdom to share with everybody? What do you see as the main value drivers from a valuation perspective?
I think to start with, growth of your company is going to be a big one, right? So if history shows that you've been growing by 5% each year, and when we do the income approach, we're looking, okay, what do you expect in the next 5 years, 6 years? And somebody says 20%. I'm going to say, well, you're crazy because it was 5% back here. How do you get into 20%? So give me a good story, and then maybe we can get there. But growth is a big one. But if you have growth without profit, obviously, so you got to have that profit. I can have a lot of growth but no profit down here. Well, that's not going to work. So growth is a good piece to be able to tell the story. Profit is a good piece to tell the story. Management, I think having good management in place is also just a very positive. If you have one person that he's the main person and something happens to him, it's done, not a whole lot of value there.
Yeah, I would just say quickly to expand on that, you know, if you're an owner or a CEO or an executive, you know, make it so you can transition out and the business isn't about you, and that brand is beyond you as the owner. I think with a lot of our clients, you know, you lose 1 or 2 people and you have a very bad situation. So I think to the extent that owners and operators of businesses understand that, I think that's going to create a lot of value in terms of the risk that's associated to a buyer to buy that business.
And I just add, if you're proud of your business, you've got a good brand, you've got a good reputation, you're known for conducting yourself in a manner of integrity, these things can all get you a premium on the value of your business, and we can certainly help reflect that. But you got to tell the story and you got to back it up. I'm going to add one more thing here that's maybe not a positive, but how would you like to be a company that 50% of your sales are to Walmart? Valuing that business is a significant challenge for us, particularly when we look at it 3 years later and they lost Walmart because Walmart went to somebody else because they got a 0.5% price increase. Good customer base with good contracts. Work with your attorneys. Make sure you got all your ducks in a row. All of those positives can add significant value to your company and allow you to convince a potential buyer that you're worth buying.
All right, last couple things on my side. March 22nd, we're going to be talking about mergers and acquisitions right here. April 12th, again, back a week from the normal first Thursday, Larry Abdo. And then I saw Darren Lynch floating around back there in the hallway. I don't know if he's still there or not, but I didn't mention, but I will now. A week from tonight is the Irish Titan Customer Appreciation Event at Cooper from 4 to 8. So if anybody's interested in that, it's a great party. Darren and his team throw good parties. And anybody who'd like more information on that, let me know. Again, that's March 8th in the evening. So let's give the panel a round
free
of...
Uber rides, by the way, since Darren's not there to advertise that. So.
Anyway, round of applause.